Welcome everyone once again, and we'll begin our session today. It's a webinar co-hosted by Shah Advisory Services LLP and Dewan P and Chopra and Company. We are going to discuss about the new overseas investment framework. I'm Sneh Bhuta, and I'll be your host and moderator for today's session. With this, we'll move to the introduction for our speakers for today. Our first speaker for today is Mr. Dhruv Chopra. He's the managing partner at Dewan P and Chopra and Company Chartered Accountants and managing director at DPNC Advisors Private Limited, which is the management consultancy arm of Dewan P and Chopra. And it has also been ranked in top 10 VCP transaction advisors in India. Dhruv has a rich experience spanning more than 18 years across transaction advisory, risk advisory, income tax, statutory audit, regulatory matters for leading domestic and international clients. Dhruv has been leading the multifamily office service of the NPC Group, advising 27 of the top 200 promoter families in India on their tax, regulatory, succession, philanthropic, and investment matters. In terms of education, Dhruv has previously trained with Arthur Andersen and KPMG as a chartered accountant. He's also holding a master's degree in finance from University of Manchester and Manchester Business School, United Kingdom. He has received the honors degree in commerce from Sri Venkateshwar College, University of Delhi. He currently holds a few various key positions, one of them being member of National Council of Internal Audit and Risk Management of ASSOCHAM, member of National Council of Startups, member of Export Committee of Banking, Finance and Insurance of PhD, Chamber of Commerce and Insurance. Dhruv has also been a mentor to numerous startups and advisor to corporate boards and holds position as a trustee on various private trusts. With this, we welcome you, Dhruv. Now, moving on to introducing our co-speaker for today, Ms. Dinah Matthias. Dinah Matthias is a partner at Shah Advisory Services LLP, a niche professional services firm rendering suite of value-added services in business and transaction advisory, cross-border advisory, risk and tax advisory, valuations, family office matters, and consistently delivering authentic, simple solutions relevant to clients' complex challenges. It comes with a legacy of partners who brings a wealth of experience spanning more than 40 years in diverse and complex transactions with over 4 decades of highly satisfied client relationships. Dinah has nearly 14 years of experience in business structuring and transaction advisory services. Her focus areas have been corporate law, cross-border, inbound, outbound transactions, transaction support, and her areas of specialization include ESOP, valuation, estate, and trust planning. Dinah has advised many large promoters on navigating through their complex family business transactions, including advising family officers in investment structures in international as well as domestic markets. On the regulatory front, she has extensively dealt with RBI officials on cross-border NBFC and compounding cases. In her career, Dinah has done multiple valuations in both business and regulatory field, and she has also cleared her valuation examination conducted by the IBBI board in 2021. She addresses various forums, including WRC, Bombay Chartered Accountant Society, and was a frequent contributor in a lot of technical journals and online platforms. She has a bachelor's degree in business management studies and has qualified as a chartered accountant in 2007. With this, I would invite you, Dinah, to give your opening remarks.
Thank you, Sneh, for the kind and elaborate introduction. Firstly, a very warm welcome to all the ladies and gentlemen joined on this webinar. Glad to be collaborating with DPNCO on this webinar. And as a matter of fact, we have really received an amazing response for this webinar, which really reflects the heightened interest of all people with regards to overseas investments. And it's just not from Indian entities, but also resident individuals, especially high net worth individuals, family offices who intend to diversify their portfolio, have global exposure, and an alternate investment avenue. So very relevant for them to understand the nuances of doing investments. With the onset of the new regulations, I'm sure there would have been many doubts and concerns in terms of, what about my past dealings? What happens to them? What about how can I do in future? Is there any change? Round tripping issues, are they resolved now? And the buzzword of financial services. So we would definitely be addressing these issues, and we have incorporated practical cases to comprehend how these regulations would actually impact. And definitely a lot of effort has gone in this, and I hope that it really benefits everyone. I would request everyone to, if they have any queries, to mention in the Q&A box provided. With this, I hand it over to you, Dhruv.
Thank you. Thank you, Diana. Good evening and welcome everyone once again to our session Experts Speak. And it's a pleasure to collaborate with Shah and host this together. We thank you for sparing time in the middle of the week to be with us, and we sincerely hope that we can add value. The objective today is to clear doubts. The objective is to bring clarity to these marquee significant change in overseas investment rules and regulations. What we've also attempted to do is to try and bring practical case studies to act, to try and highlight these material changes and how they impact your routine transactions, be it as a resident Indian entity or as a resident individual. If I, Sneh, may request you to move to the next slide, please. So before we all delve into a deep dive into the rules and regulations, I thought I'll just give you a quick lay of the land of the law as it stands today. On 22nd August of 2022, there were two notifications issued. One by the central government, Ministry of Finance, Department of Economic Affairs, which issued the overseas investment rules for the first time, and the Reserve Bank of India simultaneously issued the overseas investment regulations. They both are effective from the date of issue, which is 22nd August 22. Corresponding to these two notifications, there has been amendments to master directions. The first one being for overseas investments, the second being for liberalized remittance scheme. The third amendment was brought to the reporting mechanisms and compliances, and the fourth was for acquisition and transfer of immovable property. All these have been amended on their subsequent dates as recorded on this slide. What that impacted was what we are discussing today, which is overseas direct investments for an Indian entity and a resident individual, overseas portfolio investments, a definition that has been played with before but never coined, so coined for the first time and clearly defined as a framework. Your ability to invest as a person resident in India in debt instruments, your ability to acquire and hold immovable property outside or to transfer it, to gift it, to inherit it. Your ability to incur or to participate in current account and capital account transactions, and of course, requisite compliance and reporting thereof. The idea behind these amendments continues to be liberalization, continues to be streamlining, and much of it has been achieved, as we will discuss through the course of the next 1 hour, 20 minutes. Please. So quick, just cap of the index of how the next 1 hour, 20 minutes will be. Diana will take you through the non-applicability of these rules and regulations on certain transactions, so what we call as carve-outs. some key concepts that have been introduced or revised, which are material to your understanding these new rules and regulations. And then we broke it down into three key segments. The first was overseas investments by Indian entities. The second was overseas investments by resident individuals. The third is overseas investment by other entities, such as an AIF or a fund or a trust. And the last is other key amendments pertaining to gifting or inheritance and related reporting and compliance. So enjoy and please do participate. Please do share questions as they come to you in the question box. So we will try and address them at the end of the session. Diana.
Yes. So as much it's important to understand how these regulations impact, it's also important that we understand the non-applicability of these rules, as it may save you all from the compliances that these regulations warrant. So what's the first exemption? That is any foreign investment made by a financial institution in IFSC. So in an IFSC, a financial institution doing overseas investments, these rules will not be applicable. They are outside the purview of these rules. This is definitely to attract more investment in the gift city. The second aspect is acquisition or transfers of foreign investments made by persons resident in India. The three carve-outs are out of foreign currency resources held outside India by a person who is employed in India for less than 3 years. So these are persons who are not permanently resident in India. They have come in India for a small stint, and hence they would be having foreign sourced resources outside India. So those assets would not be part of these regulations. These regulations would not govern those assets. They are free to deal with them as they like. The second exemption is in accordance with Section 6(4) of the Act. Now, this is with regards to properties like foreign security, foreign currency, or immovable property, which you held as a non-resident. So if you held these assets as a non-resident and have now come back to India, so you're returning Indian, but these were all assets from foreign sources. So these have been kept out of these regulations. Similarly, if you have inherited any property from a person resident outside India, the genesis being again that these are all foreign sourced, these regulations are not applicable to these assets. This was also there earlier, so it continues even today. The next is resident foreign currency account. Now, this account is a facility to the returning NRIs for them to have an account opened in India, and whatever sale proceeds they have out of the assets earned overseas, that proceeds they can retain in India through this RFC account. So similar advantage has been given to balances held in the RFC account, that any acquisitions, transfers done from that account will not be governed by these regulations. Also, one fact would like to highlight is what happens to those erstwhile investments prior to these regulations that were done. So the regulations mentions that as long as it is compliant with the earlier regulations, that will be deemed as the investments under these regulations. So all of those investments would now henceforth be governed by these regulations. Yeah. Next. Okay, so before we get into each of the provisions, it's very important to understand the key concepts that are used in these regulations. And very much so, the two fundamental and key concept to be discussed is the overseas direct investment and the overseas portfolio investment. Yes, so overseas direct investment and OPI, these are the terms repetitively being used across the regulation. And in fact, I think at the end of this webinar, we would have used this 100 times. So let's look at it from the ODI perspective first. So there are 4 limbs to the ODI, and it starts with acquisition of unlisted equity capital. Now, this is a big change compared to what was there earlier, and also misreported by a lot of newspapers and news channels, which said that you can do, an OPI in an unlisted equity capital. However, as evident from this definition, any acquisition of unlisted equity capital will qualify as an ODI investment. There is no exemption provided in terms of any threshold limit. Earlier, this was permitted as a portfolio investment under LRS, though portfolio was not defined in the erstwhile regulations, and it was liberally interpreted by various people, ranging from 10% to even 30%, 40%. Practically, we were aware that RBI had a 10% threshold. So only up to 10% investment in an unlisted equity would actually qualify as a portfolio investment. But now even that has been done away with. Even a 1% stake by anybody, be it an Indian entity or a resident individual, if they invest in an unlisted equity capital, that will be now a ODI. Next is subscription as a part of memorandum that continues as is. So anything that you set up, any entity that you set up overseas continues to remain as an ODI investment. The next 2 parts are with respect to listed entities. So there is a threshold introduced of 10% for listed entities. So anything more than 10% is constituted as an ODI investment. Less than 10% if you have control. This is another aspect which is continuously being used in the regulation, the importance of control. So if you have control in an organization, even with less than 10%, you would be falling under the category of ODI. Let's look at the OPI definition. So the OPI definition starts with investment in foreign securities. So that's the key word, that it needs to be foreign securities. And then it gives certain carve-outs which says except ODI. So anything which qualifies as ODI is not an OPI, correct? And there are further exceptions which have been provided, that unlisted debt instruments. So unlisted debt instruments, again, a very big change, because earlier as well, under the LRS regime, you could invest in a debt instrument. But now they have categorically prohibited unlisted debt instruments for individuals. So you can see that this does not form part of OPI. The others are any security issued by a person resident in India other than IFSC, that's okay. Derivatives, any derivative instruments unless permitted by RBI, and definitely commodities including bullion. So these are not allowed under the OPI route. Going ahead. So we have debt instruments. As we've seen that the OPI definition mentioned about unlisted debt instruments not being permitted. So it's very important to understand what is debt instrument. So let's have what are debt instruments. So debt instruments are basically corporate bonds, borrowing in loan, government bonds, depository receipts, and securitization transactions related to the non-equity or debt-related portion. So these have been categorically named as debt instruments. We have another portion called non-debt instruments. Interestingly, this has been defined, but it's not being used in the entire regulations. It does not find place, it has no backbone, because if there is no provision regarding it, what are we supposed to do with this definition? It just gives us a perspective in terms of how RBI perceives these instruments. So it does not perceive these instruments as a debt instrument. So anything pertaining to equity, any depository receipt or securitization transaction pertaining to equity, capital in LLPs, They have mentioned units of AIFs, REITs, InvITs, or mutual funds, ETFs with higher than 50% in equity. These are non-debt instruments. You also find a mention of contribution to trust. Again, firstly, the definition is not used. And secondly, trust also has not been used in the entire regulation. There is no mention of whether you can set up a trust, whether you can receive things from trust. So the regulations are completely silent with this regard. If we go to the updated LRS regulations, it still has the, go to the previous slide, please. The updated LRS regulations, it still has a provision of gift and donation. So that is still a part of LRS. So if you read the two, our view is that yes, that can still continue as a gift or a donation to a trust overseas. But apart from that, it has no mention anywhere. Yes. Next is financial commitment. So financial commitment is in relation to all ODI related investments and debt thereon. So it includes the ODI by persons resident in India, debt other than OPI. So any debt that falls under OPI is excluded, and anything other than that will form part of financial commitment. And then non-fund based. So non-fund based are basically your pledge or your guarantee related exposures that you take. Those limits will also be considered in your financial commitment. The limit of financial commitment, that is your 400% net worth, that remains as is. There is no change in that. Also, the investment, overall investment limit above which you need to take RBI approval, that also remains as is. So all of this ultimately culminates in overseas investments, which has financial commitments, which is largely pertaining to the ODI investments and the OPI investments by persons resident in India. So I believe these are the key concepts that will take us through all of the slides that we have to discuss.
Thank you, Diana. Now that we've been inducted into the world of ODIs and OPIs and OIs, which we've been enjoying for the last week, so we can move into the first part of the session, which is or the segment, which is overseas investments by Indian entities. So all we're talking about is a resident Indian entity investing overseas and rules and regulations thereof. If we can move on, please. Continue, please. Okay. So we all are aware of the fact historically that an Indian company which is resident in India was to invest outside India in a foreign entity carrying out bona fide business activity. However, bona fide business activity has not been defined before. The current rules and regulations have gone on to define bona fide business activity to mean any business activity which is permissible under any law in India or a law in the host jurisdiction where the foreign entity is incorporated. So that's pretty wide. That allows you to do quite a bit. The limitations or the prohibitions are only to the extent of non-permissible businesses. There are some restrictions historically, again, which have been eased out in what we can do as bona fide business activity outside. And to the extent of those changes, we've taken the liberty of sharing them with you. The first is, as Diana said in the beginning, the buzzword financial services. There is a material change in financial services. If an Indian company, which is not in financial services activity, decides to pursue financial services outside, historically, they could not do so. Now, pursuant to the new rules, they can engage in financial services activity outside. So an Indian company sets up a vehicle in Singapore. The Singapore vehicle wants to allocate capital or invest capital received from India as financial commitment into instruments, including equity, securities, debt, alternate investments. Then you are technically currently permitted to do so. There is a requirement for the same, which is, as an Indian entity, you need to have profits for the past 3 years to pursue the same. You cannot do this for banking. However, you cannot do this for insurance. It's interesting because while they have given this or carved out this permissibility, they have also mentioned that RBI may issue additional rules regarding the same. So I think it is prudent to await the same. Now, if you're an Indian entity which was already doing financial services activity, then you can also pursue the same activity outside, subject to an approval by the financial service regulator. And of course, you also need to have the 3-year profit requirement historically. So in both cases, if you're an Indian company not pursuing financial services, you can do the activity outside. And if you are pursuing financial services, you can still do the activity outside subject to conditions. The second carve out, real estate activity. It's always been a consistent question over the past many years. And real estate activity, which is buying and selling of real estate, is not permitted. Transferable development rights, trading, not permitted. There were then carve-outs to that. You could construct townships, you could construct hotels, you could do student accommodation, roads, etc. And now there's a new carve-out, which is you can, as a business, as a bona fide business activity, set up a foreign entity to construct and lease real estate. The word lease was not there before. It was limited to construct and sell. So the fact that you can actually go and buy land in a foreign entity and then construct on it and then lease the asset and hold the asset for capital appreciation and a yield that comes off, and you can raise leverage in that entity, makes it an interesting opportunity to explore. What is construction? Will joint venture collaborations be permitted? These are, again, aspects of detail that have to be seen. The third carve out, again, taking a buzzword forward, is the startups. Earlier, there was no specific permissibility. Now there is. However, there are certain conditions for an Indian company to invest in a startup outside. The investment has to be from your own funds. Own funds is internal accruals. It could also be capital from your group entities, but cannot be from external agencies. More importantly, it now says that if you invest in a startup outside, you have to be investing in one that is recognized as a startup in the foreign jurisdiction. Very interesting, because practically not every foreign jurisdiction has a system of recognizing or stamping an entity as a startup. So India does. We have the DPIIT registration or the income tax registration, which is not mandatory, but usually preferred for certain exemptions and benefits. But similarly, in international jurisdictions, I'm not sure how it will play out and what will be sufficient paperwork to support the startup recognition. But again, details will emerge. The next was strategic sectors. So if you wanted to invest in a business outside, in a strategic sector, there was certain leniencies, or there are certain leniencies that have been offered. If strategic sectors would be oil, gas, mineral, ores, and including startup. And the leniency is that you can invest in these strategic sectors if you want to go beyond the limits which are prescribed. So for example, if the financial commitment limit is 400% of your net worth, and you want to invest beyond that in these sectors, then you can take central government approval to do so. And the same principle applies to startups. Another leniency is your ability to invest in unincorporated entity outside to pursue such strategic sector projects. Why that's a leniency is because currently an Indian entity can only invest in a limited liability entity outside and not an unincorporated entity, which may have unlimited liability. I repeat, this is subject to central government approval. And last is the ability of an Indian company to invest into listed or unlisted equity, which would be part of ODI, and listed unlisted debt. These two we delve deeper into as we go along. So let me take the first, which is ODI by an Indian entity in equity. Before I delve into that, there's another material introduction, which is the definition of control. This is pertinent for the entire rule and regulation. The definition of control, you will see, pops up again and again and is extremely relevant to understand and appreciate. And it's reasonably wide. So control is if you own more than 10% equity in a company, Control is if you own less than 10% in a company, but you control management, you control policy, you control your ability to appoint board members. And this is to be seen individually with people in concert. It is to be seen directly, it is to be seen indirectly, it is to be seen in substance through voters' agreement, shareholders' agreement, and other agreements that may be at play. So very interesting. Now, again, before I come to the case study that we've lined up, let me just take a few key considerations of what would tantamount to ODI by an Indian entity in equity. Firstly, you need to make sure that whatever you do is bona fide business. The second you want to ask yourself is, does the Indian entity have control on the foreign entity? And that has a relevance, like I mentioned. And the third is, are you investing in a listed entity or an unlisted entity? So let me apply these considerations to the case that we have here. Let me just try and annotate for you. Okay, so if you have Reliable Limited, let's say it's an entity incorporated in India, and the entity has 5% equity in a foreign entity. 5% means less than 10%. Let's assume it does not have control, and it invests into listed company one. In this case, if there's no control, this will, and you invest in the listed company, it will not be ODI, it will be OPI. Let's take another, and we'll delve deeper into OPI, but this is not ODI. Let's take a second case. Let's say there's 15% equity holding by an Indian entity into the listed company outside India, and there is control. That will tantamount to ODI. Let's take a third case. If there is an entity which invests into an unlisted entity where there is, let's say there is control, in that case, it will be ODI. Reason? You can only do investment as an Indian entity in an unlisted foreign entity through the ODI route. You cannot do it through the OPI route. And it's irrelevant whether such entity will have control or no control. So simply put, if you invest as an Indian company in a foreign entity which is unlisted, it will always be ODI. If you invest in a listed company outside where you don't have control, it will fall under OPI, Overseas Portfolio Investment. And if you do have control, it will be again overseas direct investment.
Just adding to what Dhruv was mentioning on control, we have seen, a lot of flip structures happening, and due to the earlier regulations and restrictions, we have seen that there have been wherein the companies have been flipped overseas, and the promoters through certain contractual arrangements are ensured the upside of the foreign entity, and they also enter into these voting arrangements by virtue of which they are able to have some kind of a control over the overseas entity. So I believe RBI wants to take hold of such transaction as well and bring them in the net of ODI. So this is really very interesting, and it's interesting to see how the earlier transactions that have happened, how in the light of these new changes, what would be the view of the RBI and what compliances they would need to do. Yeah.
So Dhruv, we have some questions from the participants, and I would like to take up two questions as of now.
Sure.
One being, what are the kind of instruments in which we can invest under the ODI route?
So under ODI, from an equity perspective, because right now we're discussing ODI by Indian entities and equities, you can invest in equity capital. So equity capital would include equity shares. It would include irredeemable capital. It would include anything that's compulsorily convertible, so CCPS, CCDs, etc. So in terms of capital that's remitted, that's what is permissible.
Okay. And is there any other mode for doing an ODI?
Yes. So there will be the permissibility to do non-remitted capital ODI. That, for example, would include if you swap shares. It would include issue of bonus shares. It would include capitalization of any receivables, subject to you having permissibility under the rules to hold such an investment. It would include any reconstructions that may happen, a merger, a demerger, and consequent issue of shares to a transfer company out of India. So yes, to that extent, all of these would be where no remittance of capital happens, yet you will fall within the ambit of ODI.
Thank you, Dhruv.
Okay, thank you. Right. Okay. So now we're covering ODI by entities in debt instruments. So ODI by an Indian company in debt instruments. Key considerations here, again, material change, very material change. An Indian entity can only invest in unlisted debt if you have ODI and if you have control, which effectively means that if you're a company in India and you own 5% shares in an unlisted company and you don't have control on the company, then as an Indian entity, you cannot subscribe to the debt of that company. And debt would include anything. It would include loans, it would include any kind of bond, securitization, etc., as Diana has already detailed. So that's one very material change. Earlier that was permissible, now it's not. The second is in terms of debt instruments. So debt instruments would be a varying, would include corporate bonds, would include government bonds, would include any kind of loans, would include any kind of depository receipts, so on and so forth. So it's a wide range of potential instruments that you could adopt. And the last, which is again an introduction by the rules and regulations, it's you as an Indian company, if you give a loan to a foreign entity, you have to have an agreement at an arm's length price or paperwork to substantiate that the transaction happened at an arm's length price, which could include having a valuation report for any debt that you may pursue, be it listed debt or be it unlisted debt. So again, additional paperwork and what would qualify as sufficient paperwork is to be seen. Now, let me take these considerations onto the case study. We just took two simple case studies. The first was in an Indian entity, which is a limited company, which invests 5% in a foreign entity, and there is no control. So 5% in a foreign entity with no control, and you issue unlisted debt, is that permitted? Answer is no, right? Let's take another example. If you take 15% holding in a foreign entity and you have control and the debt is listed, then it is permitted. If the debt is unlisted, it is still permitted. So effectively, you could do listed debt even in this case. So suppose Reliable Limited had to subscribe to listed debt of the ODI in the foreign entity, it could do so, but it can't do so if it is unlisted debt where there's no control. So that's the key point we are highlighting.
So Dhruv, just one question here. Like we spoke about CCPS in the previous slide. So whether can we invest in an optionally convertible preference share or a redeemable convertible, non-redeemable, or say redeemable preference shares under this route?
Yeah, it's a good question. So if you go to the master direction, the definition of equity clearly states that any optionally convertible instrument or a redeemable instrument would be considered as debt, which means if you take any of these OCPS, RPS, OCDs, subject to compliance in the host jurisdiction, all of it will be permitted or will be construed as debt for the purpose of ODI.
Okay, another follow-up question. So what if an Indian entity wants to do only investment in a listed debt instrument and it does not have any kind of ODI into that entity? Would that be permissible?
Yes. If you do not have any ODI in the listed entity, it is permissible, but there's an interesting aspect, which is if you do not have ODI, then it will fall under the purview of OPI, because it is only under overseas portfolio investment that an entity in India can subscribe, Indian entity can subscribe to listed debt. And I think that's being taken up by Diana subsequently.
Thank you, Dhruv.
Diana, would you like to add anything on that? Should we move on?
Yeah.
Okay, we can move on. All right. The last part on the ODI by Indian entity is investments in IFSCs. So International Financial Services Center, the first is in Gandhinagar and the gift city, as we call it. Now, there have been some incentives given for Indian companies to route investments out of the IFSC. As Diana mentioned earlier, any investment by a financial institution through the IFSC is outside the purview of the rules and regulations. So other than financial institutions, we've taken two interesting incentives that I think are worth mentioning. The first is, let's say an Indian company engages in financial services activity, right? Let's say we're here. And this company has control over an IFSC company, which for the purposes of the rules is a foreign entity. So any entity incorporated in IFSC is a foreign entity and will fall under the rules and regulations here. Now, such an entity, the incentive given is if you are in the business of financial services, then to do ODI, you have to go get approval from the concerned financial service regulator, SEBI, RBI, as the case may be. It has been prescribed that such approval for such investment has to come within 45 days. And if it does not come within 45 days, it is deemed to be approved and the concerned Indian entity can continue business. There is another condition that the Indian entity in this case has to have profits for more than 3 years as a track record, 3 previous years. Let's go to the second example. Let's take an example of a company which is not engaged in financial services activity in India, similarly has control, sets up an entity in IFSC, which is now a foreign entity. Now, such a company, as I mentioned previously, would need 3 years track record of profit. However, in this case, they have exempted that requirement. And that again would ease or allow a number of companies, or you can set up a new company to carry out this activity. Important to mention, banking and insurance is not permitted under this space. Diana, you had an interesting experience that we thought is useful to share with the audience.
Yes. So IFSC is basically an avenue for attracting foreign investments and businesses, right? So if you have a business which caters to foreign investors, then absolutely it makes sense. Of course, you need to, take the premises on lease in the gift city. You need to have the infrastructure in place. So you need to have that spend to be in the IFSC jurisdiction. But if one were to set an entity for, making investments overseas, I believe from that perspective, there would not be much tax advantage, because currently the tax holiday has been given from the perspective of conducting business. So business income has got the advantage. But if you are going to earn any capital gains in the IFSC, that is not exempt. So as a person resident in India, the company is regarded as a person resident in India from tax perspective, and those capital gains gets taxable. So from a taxation point of view, it may not be so attractive. You will have to look at it holistically, that whether it meets all the objectives, and analyze and then decide on going to the IFSC.
So basically, Diana, what we have to do is do expert speak session 2, which now brings in all the tax aspects for each of these transactions and structures and evaluate it all over again subsequently. Okay.
Absolutely. I think tax also plays an important role. So definitely we should have a follow-on session on that.
Okay. Over to you, Diana. Thank you.
Okay. So now we come to the most interesting topic of round tripping. This has really been a sore point to most who want to shift base from India to overseas, especially most of the startups and the people who are looking for funding. So they want to have the holding structure based in US or Singapore, wherein fundraising becomes easier, you get better valuations. But since as a promoter, you are a person resident in India, you need to follow the rules and regulations provided by the regulators. On that front, there was always an issue with regards to round tripping. RBI has come on hard on many of the companies, even insisting them to unwind certain transactions. So from we also get a lot of queries in terms of, from a commercial perspective, it makes sense. So why is the entire prohibition? But RBI has its own mindset in terms of whether there is going to be a flight of capital overseas, whether what is it, a track structure. So let's see how these regulations now address this aspect. So there is a specific provision now mentioned in the regulations. An exception has been provided. What they mention is that you can do financial commitment in an entity overseas, which again invests back in India, provided that it results in a structure of not more than 2 layers of subsidiaries. So this is the key point, not more than 2 layers of subsidiaries. I'll just highlight it. Yeah, so this is the key point, not more than 2 layers. Now, how is subsidiary defined? Subsidiary is defined in relation to a foreign entity, and it says that subsidiary of a foreign entity means an entity in which the foreign entity has got control. Again, control definition, we know that anything above 10% is defined as control. So only if it is a subsidiary with more than 10%, if it's an entity with more than 10%, it would be regarded as a subsidiary. So let's take this example. So if you see ICO 1 has invested under the ODI route, whether as control or no control, it's immaterial. It's always going to be an ODI transaction for FCO 1. FCO 1 has done 2 investments, one having control in ICO 2 and another having no control in ICO 3. Before we analyze whether there are layers of subsidiaries or not, in the entire structure, we can see that there are only 2 entities below ICO 1. So there are not more than 2 layers at all. So we need not analyze deeper into this transaction, into the structure. This structure is completely doable. It's now permitted. There is no iota of doubt on this structure. So both ICO 2 and ICO 3 investment will not be considered as round tripping and will be permitted. So what transactions may be considered as round tripping? What if there is another layer after FCO 1, which is FCO 2? So let's look at this structure. So here now we've got ICO 1 in FCO 1. So this is there. Then there is FCO 2. So if you see this leg, right? FCO 1 has control in FCO 2. We had looked at the definition of subsidiary. Now, interestingly, the subsidiary definition is not a generic definition as we understand. Usually subsidiary is defined as more than 50%, but as per RBI definition, it's more than 10% and only in relation with foreign entity. So where do we count these 2 layers from? Do we count it from ICO or do we count it from FCO? How do we count it from ICO? Because there is no concept of a subsidiary relation between ICO and FCO. There, like earlier, we used to have JV and WAS concept. That concept has been done away with. So everything is just regarded as plain ODI. So there is no concept of subsidiary over here. The only concept of subsidiary starts from the FCO level. So if you look at the left-hand side, wherein we've got FCO 2 as the first. So from that perspective, FCO 2 will become the first layer, and then ICO 2 will be the second layer. So still, this complies with the condition of not more than 2 layers. So in our view, this will still be a permissible structure of having 2 layers. So this usually, you have this FCO 1 in an intermediate jurisdiction. You can have FCO 2 as an operating entity and having multiple subsidiaries all across the globe. So this structure is permitted. If you look at the other leg, which is ICO 3, this is completely doable because there is no control. So it's not regarded as a step down subsidiary at all. So this is also doable. So this entire transaction from a round tripping perspective, we believe is a completely doable structure. Yes, I think one more thing, one more important aspect that I would like to highlight is the timing factor. So earlier, people used to interpret that if a structure already has 2 or more layers of subsidiaries at the time of investment. Now that has happened prior to we entering into the transaction. So those transactions are to be disregarded, but that's not the case now. RBI has specifically mentioned that you need to check this criteria at the time of investment and thereafter as well. So at the time of investment, if there exists any such structure, you cannot acquire such company. Neither after acquiring a company at 1 level, you cannot increase it to more than 2 levels. So you have to have this condition complied all across, pre as well as post. So this is an important factor which needs to be considered. Yes. I'll just clear. Okay, I think so the last part in the Indian entity segment is OPI. So let's look at OPI investments. We've seen how ODI works across all instruments. The OPI by Indian entities is also a factor. So let's look at that. So under the OPI route by way of remittance is only available to listed entities. Please be clear that it's only available to listed entities. And so listed entities up to 10% investment in foreign listed entities can do OPI. And another limit is up to 50% of their net worth. OPI by unlisted entities is not permitted. It's only permitted in very certain specific cases. So by way of remittance, an unlisted entity cannot make direct investment in any listed entity overseas. So OPIs per se are prohibited to unlisted entities, except a small carve out has been given. So what is the carve out? I'll mention that as well. So the carve out is the similar things that Dhruv mentioned earlier, the non-remittance modes. So what are the non-remittance modes? The capitalization of dues. So for example, you've got certain outstandings from a listed entity, say Alphabet, parent company of Google. You have some outstanding and Alphabet says that instead of making payment, I'll give you shares of my company. So through that mechanism, you can get the shares of that company because you have not remitted anything overseas. So by way of capitalization of dues, you can get an OPI investment. You can get 1% investment. So it has to be less than 10%, of course. And the rest of the ones which Dhruv explained, so swap, merger, demerger, rights issue, bonus issue, all of these modes are the only available modes for an unlisted entity to enter into the OPI space. So if I just take this example quickly, Reliable, which is a listed entity, if it can, as I think already mentioned earlier, 5%, less than 10% in a listed entity, this is permitted. This will become an ODI transaction. This will become an ODI transaction because it's more than 10%. In case of private limited, because it's more than 10%, this will be also an ODI transaction. It will be an ODI transaction. And this is not permitted except in those cases which I mentioned. Yes.
Diana, so I have a question similar to what I asked through, is what are the instruments permitted under the OPI route?
Yeah. So as earlier I had defined that, what are the inclusions, exclusions. So just to be clear, because it's going to be applicable for all. So what is the instruments permitted under OPI? So all listed instruments, be it listed equity, be it listed debt instruments, these are the instruments which are permitted under the OPI route. From an unlisted perspective, you could say the non-debt instruments, right? So which were the non-debt instruments mentioned? So units of an AIF or an InvIT or a REIT or units of a mutual fund, they have not mentioned them to be listed. So you still can invest in units of a VC fund, in an AIF fund overseas, even though it is not listed. So these are the instruments which you can invest under the OPI route.
And
also, yeah, just before that, one very key change that has come, which I missed, is in terms of reinvestment period. So there is, in terms of any investments that you do overseas, there is a time period within which, if after sale, you need to get the proceeds back to India. Now, for OPI investments, even for Indian entities, they have brought the change that you can retain and reinvest these proceeds overseas and need not bring it back to India. But the only condition being that the reinvestment needs to happen within a period of 180 days. So that's the condition, that you can't keep the funds idle for 180 days. You necessarily need to reinvest the funds and then you can retain it. So that's an important provision which they have brought. It's a very good provision, because a lot of listed entities who would have done investments overseas are now entitled to keep those funds overseas.
Interesting. So I just wanted to ask like a follow-up question in terms of sector restrictions or having restrictions for subsidiaries, or maybe say round trippings, anything applicable for OPI?
So fortunately, OPI is a very relaxed and liberalized route of investment, because the RBI recognizes the fact that these are only instruments in which you don't have any control. So how can you, dictate any terms with how that foreign entity can conduct its business? So there are no restrictions with regards to any of the sectors. So financial service sector or banking, insurance, all of these are open. Even real estate business buying, selling, these are fine for an OPI investment. There is no restriction under SDS as well for an OPI investment. Yeah, I think so. You asked about sector and step down subsidiary.
Yes, and I also asked
One
about
thing,
round tripping.
sorry, before you do that, Diana, the interesting aspect is you can only do OPI in listed entities. So
Correct. Yes.
No control is important, but even the fact that
it is listed entities,
there's very little that you can do about it. These listed companies will have global business and so on and so forth. So multiple structures or complex structures. Yeah. Sorry, back to you on round tripping.
Any restrictions in terms of round tripping for OPI?
No, as SDS restrictions are not there, so there is no condition of round tripping as well. So it's only the condition has been mentioned under the financial commitment, which I said. So that's only from the perspective of ODI.
Thank you, Diana. I think we can move to the next slide.
Okay, I do believe that however much we're enjoying, we're a little behind time.
Yeah.
So we need to hasten the process. So I'm going to try and do that a little bit. Let's go to the next aspect, which is overseas. Again, very, very important for a lot of the audience, because family offices, resident individuals, high net worth individuals will have overseas exposure in the form of these investments. And there are material changes, and that's what we're going to address. If we may please. So again, restricted to resident individuals. As we know, this is governed by liberalized remittance scheme. The quantum of capital that you can remit in a year continues to be 250,000, no change. We split this into 4 aspects. The first was overseas direct investment. Earlier, what used to move into JV wholly owned subsidiary route. as it was known. And under the ODI rules, as they prevail with effect from 22nd August, it's a resident individual largely is at par with Indian entity, but there are some key differences, and I'm going to point those out. So one, of course, it has to be an operating foreign entity. The second is that you as a resident individual cannot set up a business outside to do financial services activity. Not permitted, other than that one exception we pointed out for the case of IFSC. The third is if you cannot have a step down subsidiary unless the resident individual has control. Oh, sorry, you cannot have a step down subsidiary where the resident individual has control. So those are very important, and we're just moving into a little bit more detail of that as we go along. The second is OPI. Again, important to note that a resident individual cannot subscribe to unlisted debt. Very common to do so. You can give loans to a company outside. It could be a family company. It could be your own company. You can no longer do so under OPI. So again, a big no-no, big change. Current account transactions remain the same. I'm not going to delve into them given time is short. Capital account transactions, everything remains the same, but two material changes. One, pertaining to acquisition of immovable property. There's a very important change which we'll address down the presentation. And two is in context of capital, which is lying outside under LRS and may need to be repatriated back to India within a prescribed period. So that's a huge change. If we'll move to the next slide, I think it will address this specific aspect. So on repatriation of funds, we took 4 simple instances that are probably most common, and we compared what was it pre-2022, pre-August 22, and what it will be going forward. If you have an investment under ODI route, or what was erstwhile JV wholly owned subsidiary route, and you transfer those shares and you have some gains earlier, you had to bring the money back in 60 days. Going forward, you have 90 days from the period of disinvestment to bring the money back. So this is liberalized as opposed to there's no tightening here. The second is if you have any remittance other than ODI. So let's say you own bonds of listed bonds outside under LRS. Earlier, there was no requirement that when you sell the bonds to bring the money back, whereas now you are to repatriate the money back to India within 180 days, if not reinvested. So the need to repatriate is only if you don't reinvest the money within a 180-day period from the time that you disinvest. The third is idle funds, the most common. You have capital lying in a bank account, a foreign bank account. So that's permissible, continues to be permissible. But if it's lying idle for 180 days, then you have to repatriate it back to India. But if it's reinvested within that 180-day period, then there is no need to repatriate it back to India. So it's very important to review your LRS allocations, your capital investments under the new rules and regulations to ensure that what you invest into and what's lying idle and how you want to utilize it without taking undue risk. I think this is critical going forward. The last part, which is reinvestment of income earned on investment, interest income, dividend income, etc. When you get that income, there was no requirement to bring it back. Now, again, there is a requirement to either reinvest or repatriate within 180 days of that income. So material change. I'll move to the next, which is resident individuals' investment in equity through ODI. So for ODI purpose first, let me just take the following considerations. Like I said, it's at par with the considerations that exist for an Indian entity and with a few additional restrictions. So the first is, of course, if let's take a reasonably popular name, Mukesh, and let's say Mukesh wants to invest outside India, then you need to make sure that the entity in which you invest is carrying out bona fide business activity. The second is that you cannot give debt to such an entity if it's an unlisted entity and if it's an unlisted entity, that's point number 2. The third is you cannot have any step down subsidiary to such an entity. Again, very, very critical if there is control. So if there's no control, then you can have step down. So let's say you have a listed company, you own, or unlisted company, you own 5% of it, and we'll address that in the case study. And the last part is you cannot do financial service activity. So let me quickly, again, just try and do a quick highlight on the case study. So Mukesh invests 5% without control in a listed company. That's OPI, that's not ODI. So you need to do OPI compliances thereof. Let's say you have, again, Mukesh investing 15% with control in a listed company outside. That's ODI. So that falls within the 400% net worth route, and you will do compliances for ODI. And the important reason of distinguishing between ODI and OPI is, of course, 2. The first is how much money can you invest, which is in OPI, it's 50% of net worth. In ODI, it's 400% of net worth. And the second reason why this is important is compliance, because OPI compliance is now reasonably more liberalized and less stringent than ODI compliance, which continues to follow the old suit. Back to the case. So if I take Mukesh investing 5% without control in an unlisted company, as you recall, any investment in unlisted company is ODI, it's permitted. And the last is 30% with control, again, in an unlisted company is ODI, because you cannot do anything but ODI in unlisted entities. So it's a bit, it's a little, it took us a little while to wrap our head around it. And I'm sure it's not easy to get this, to soak it in one shot, but we're trying to at least give you a good feel of what
just one thing, Dhruv, here, I think the LRS limit would apply for Mukesh.
Yes, sorry. Yeah. My apologies. Absolutely. Spot on. It's over there. Correct. It'll all be 250,000 route. That's right. That's absolutely right. Okay.
So Dhruv, I think I'm going to ask my favorite question up till now, in terms of instruments. So is there any change vis-a-vis the instruments definition for Indian entities versus resident individuals for doing ODI, OPI?
No. In terms of equity, it continues to be the same. And in terms of OPI, it will continue to be the same.
Okay, and any kind of exemptions available for resident individuals for investing in IFSC?
Yeah, I did cover that. That IFSC, you are not allowed to do financial services activity as a resident individual unless you route it through a foreign entity incorporated in IFSC. So to that extent, there is technically there is leniency. Practically, how that works out in light of what Diana said needs to be seen.
Thank you.
Yeah.
Okay, so I'll just quickly take you all through. Dhruv mentioned that the SDS is not available to resident individuals. So from this example, we can just quickly analyze that. In the first example, Mukesh has got control in FO1. So there is control, and hence FO1 is subject to the SDS restrictions. So this will not be permitted because this is a controlled transaction. However, this will be a permitted investment because this does not qualify as an SDS. In this example, at the first level itself, there is no control. So if there is no control over here, the SDS restrictions do not apply, and FCO is completely permitted to invest the way it wants to invest. Secondly, there is also a repeated question with regards to round tripping applicable for resident individuals. We have seen round tripping for Indian entities. Now what about resident individuals? So as there is SDS restrictions, so there is in case there is control, the similar example would follow. You have to just place these entities in India, and if you have control, that entity is not permitted if you do not have control. So if FCO 3 was an ICO 3, this would have been a permitted transaction. This would not be a permitted transaction. Similarly, FCO 2 and FCO 3, if they were incorporated in India, since directly Mukesh does not have any control, this would be a permitted transaction, both of these. Going to the next. So as we have harped on a lot of control, what if an individual, okay, not individually, but along with his parents, spouse, invests less than 10%? Okay, we've seen a lot of such transactions happening earlier where individually people were investing and saying that each one of us has done a portfolio investment. So will this now sail through concerning the revised regulations? So please recollect the control definition, which says that it's not only singly, but along with persons acting in concert. So if these are all persons acting in concert, the overall stake increases more than 10%, and therefore it breaches the control threshold, and all the rules and regulations that are applicable will fall in place. So it cannot, FCO 1 cannot have another subsidiary if it has cumulatively more than 10% stake. So this is very important to understand that now these transactions cannot go through. Yeah. Another way of, for a resident individual perspective to invest is also by way of, any pending dues. You see professional fees are given, and in lieu of that, you get shares, you get ESOPs, which is very, very prevalent and relevant for most of the individuals over here. So from that perspective, again, the similar concept of ODI, OPI has been brought in. So this is a complete change from what was there earlier. Earlier, these were not within the ambit of an ODI per se. So here it mentions that similar control and listed unlisted criteria needs to be checked. And if that is there, then you will qualify as an ODI as an OPI. If it's an ODI transaction, no SDS permitted, no financial service sector permitted. So you need to check these conditions before getting shares with regards to professional fees or any outstanding dues. In terms of ESOP, also you need to do the similar thing. If you get an ESOP of more than 10%, earlier as well, we've seen there was no threshold. Can I get 15% ESOP? Can I get 20% ESOP? So if you get anything more than 10%, it will be categorized as an ODI transaction and you need to do the reporting. However, if there is no control, right? If it's an unlisted entity or a listed entity. Now, very big change here is for unlisted entity, because all across we've said unlisted entity has to be ODI, unlisted entity has to be ODI. But there is a carve out over here that in this case, unlisted entity, if you've received an ESOP of an unlisted entity where you do not have control, it will still be considered as an OPI. Further relaxation in terms of SDS requirements are not applicable. Financial service sectors are not applicable. It is permitted. There is no limit on remittance. So if you need to remit more than $250,000, you can remit for an ESOP transaction, but the LRS limit will be reckoned. So what it means is that 250,000 will be consumed in that limit, and you can't do any other transactions within that limit. So yes, you can invest more than the $250,000, but this restriction applies. Yes. Yeah, Dhruv.
Okay, so another prominent, popular, common capital account transaction in the family office high net worth individual domain is gifting. And let's first take gifting of foreign securities to a resident individual. And let me just set the lay of the law or the way it operates now. If you're a person resident in India and you receive a gift from a person resident in India who is a relative, and the gift is of a foreign security, that today is permissible. Let me take a second example. If you're a person resident in India and you receive a gift of a foreign security from a person resident in India who's not a relative, this gift is not permissible. Now, let me change the donor. So let's say the donee continues to be the person resident in India who receives a gift of a foreign security from a person resident outside India who's a resident. That's permitted. However, there is a new introduction that such transaction has to then be registered with the FCRA, which is the Foreign Contribution Regulation Act, and requisite compliances to be done. Now, practically, that could at times be a little tricky and time consuming. And the last part is if a person resident in India receives a gift of a foreign security from a person resident outside India who's not a relative. In this case, that too is permitted, subject to registration and due compliance with FCRA. So that's the considerations that we have. Let me take that to, so this is what we covered here. And let me take that to the consideration if you were the donor, so the person resident in India to gift to a person resident outside India, that is no longer permissible. So if you have a foreign security and you want to gift to a person resident outside India, that is no longer permissible. However, if you want to gift to a person who is an Indian resident, that of course is permissible. We already discussed that. It's just the two sides of the same coin. Let me take this to the idea of the resident individual. Before I do that, Diana, was I clear in what I said? Because this is slightly tricky. I know I'm clear on receiving the gift. On giving the gift, is it clear that you cannot give a gift to a person resident outside India if you're resident in India?
Yes.
And that's a material change.
Yes.
Because historically, that was not really mentioned as a restriction, but now it is clearly been restricted.
Yes.
So I want to just highlight that aspect. Let me take a few case studies. Let's say if you're a resident individual and you have a list and you receive, now this resident individual receives a gift of shares of a listed company in which the donor did not have control. In that case, assuming that it's permitted, it would fall within the ambit of OPI. So then you will have to do requisite OPI compliance. Similarly, if you as a recipient, being a resident individual, receive a gift from another permissible donor of a listed company where you had control, that would then be ODI and you would need to do requisite compliance under ODI. And similarly for unlisted company, it would fall within ODI, as we've been talking again and again for the last hour. Listed debt would fall within OPI, as all listed debt is covered as OPI under the current rules and regulations. Now, there's one interesting aspect. What if you had received a gift as a resident individual of a foreign entity which is unlisted, in which you don't have control, and along with that you receive the debt which is unlisted? Would that be permitted? And the reason we raise that question is because unlisted debt cannot, or an Indian resident cannot subscribe to the unlisted debt of a foreign entity unless you had control. So this would be an interesting aspect to study. There's no clarity on it yet. And it's very practical because it's quite common for this to happen, especially if somebody was a non-resident and then returns to be a resident subsequently and then wants to plan, certain family gifting and succession. These questions will definitely arise. And you may want to consider how you deal with these situations and plan for it. Right. There we go. Now inheritance. So inheritance is a little bit simpler to the extent that if you're a person resident in India, effectively you can inherit anything, whether it's from another person resident in India, be it a relative or a non-relative, or if you inherit something from a person who's not a resident of India, be it a relative or a non-relative, you can still inherit any foreign security. The only question again will remain that what are the requisite compliances? If it falls within the ambit of OPI, it's those compliances. If it's ODI, then it's slightly more stringent, including filing of APRs, etc. The question of unlisted debt will remain, and it'll be very interesting what view the government takes on this, because really it's an inheritance. So you can't even plan for it, as sometimes you may not know of it. But let's see how the rules emerge. The last, and again, last key aspect in terms of changes is acquisition of immovable properties. So if, by and large, if you look at acquisition of property from a person resident in India, whether by way of inheritance, by way of gift, or by way of purchase. So here we're talking about a person resident in India acquiring a foreign immovable property from another person resident in India. That is permissible as long as the asset was purchased by the transferor within the permissible rules. Similarly, acquisition from a person resident outside is also permissible, be it by inheritance or you can purchase it through your limit of LRS and RFC account, etc. And you can, and that there is no change there. There's no change there. Given the paucity of time, I want to move to where the change is. If you have a transfer of immovable property by way of gift to a person resident in India, so no longer can a gift of immovable property be given by a person resident in India to a person resident outside India. That is no longer permissible. And this too is a very material change that has now come about. And the last part is there is an introduction of a new clause, which is the ability to create charge on property. So earlier, resident individual was not allowed to create or take any loan on their holding of immovable property outside, whereas now you can create a charge, but it's not entirely clear, as it goes on to say RBI will issue rules. So whether you can take a leverage outside India or whether you can leverage the asset to take a loan in India from a bank in India, it's to be seen. But again, a material change and an interesting change. Anything there?
No.
Okay.
Okay, this is to the last few minutes, so we'll just quickly take it this. We've come to more or less the end. So just one slide on investment by other entities that's in relation to the AIF. So one change which has been done is that the India connection has been done away with. So earlier as well, AIFs were permitted to do overseas investment, but there was a caveat that such investments should have certain India connection. And so that acted as some dampeners to the AIFs. But now, since it's been done away with the SEBI, this has opened out a lot of investment opportunities to the AIFs. So they can invest overseas. There are investment limits prescribed that will still remain, but these will form under the OPI rules. So again, much more relaxed rather than an ODI regime. Next, we go to the other key amendments. A very critical amendment that has happened is deferred payment now under the automatic route. So we've known that deferred payment was allowed under the FDI regime, but similar provision was not there in the ODI regime, and therefore it required approval. We've also, looking at such cases. So this is really a welcome move, wherein now deferred payment is permitted. You just need to upfront give the time period within which the deferred payment would be done and follow the valuation norms prescribed. So that's definitely good. There is a no objection requirement from the wherever, if you're an NPA and you've got an investigating agency or a financial service regulator, there's an investigation over there, you need to get an NOC, and the NOC period is mentioned that if you don't get it within 60 days, it's deemed approved. So another change is with regards to restructuring of financials amounting to diminution of investment and write-off. So earlier there were certain criteria and approvals required. So now if you have, more than 2 years losses in the entity, then you can go in for restructuring and write-off under the automatic. The last is the last audited balance sheet. So earlier there was no defined, and you could keep whatever period. They have mentioned that it should not be exceeding 18 months. So these are the key amendments. We just go to the last slide. These are just the reporting changes. So one of the key questions would come about that, okay, I did an ODI, now what? Do I have to do all the compliances? Am I supposed to do the annual filings, annual returns, the APR filings? What does it entail being an ODI? So ODI, definitely at the initial stage, you'll do the filing, but subsequently, if you are only holding less than 10% without any control, without any financial commitment, then there is no requirement to do APR. So that's definitely a breather, a relaxation. So all those minority investments overseas, For those, this will be definitely a welcome move, because it's very difficult to get hold of financials and do the APR compliances. LSF has been introduced as a concept. Again, foreign investment had it, but ODI did not. So it will relax a lot of compounding cases, and the routine procedural cases can go under the normal LSF route by the schedule prescribed. So these are, I think we've covered and are at the end of the presentation.
Thank you, Dhruv and Diana, so much for such an insightful presentation and covering such a large subject in such a short duration, I would say, and the number of hours that you might have spent to summarize the entire regulations in a lucid manner for all of us. We have received quite a few questions in the Q&A box, and I would now like Sumit and Abhishek to take up those questions, please.
Yeah.
I'm mindful of time.
Yeah.
It's exactly 5:30, which is where we would end. So maybe we can do just a few minutes. And
Another 5 minutes, so maybe 2 to 3 key
that's
questions.
right. That's right. And I just want to add that we are tracking the questions, and respectively, Anisha and us will do what we need to do to respond to your questions or reach out to you as can be. So thank you for the questions. Sumit, sorry, over to you.
Yeah. So firstly, as expected, the audience has been extremely inquisitive in the overseas investment issue. We have received a bunch of questions. So one of the few questions which have been popped up quite a lot of time, whether you can invest in an unlimited liability entity outside India. Can you invest in a partnership firm, LLPs?
Yeah. Should I take that, Diana?
Yeah.
Okay. So the short answer is you can invest in a foreign entity. A foreign entity is a limited liability structure. So to that extent, an Indian entity or a resident individual cannot invest in an unlimited liability company, however, or structure. However, there are certain exceptions, and I'll give you one. And we mentioned that, which is, let's say if you want to invest in a strategic sector, then you can invest through an unincorporated, unlimited liability structure like an AOP to pursue that project of a strategic sector. But that too is subject to central government approval. So short answer is no, other than a few exceptions, one of which I mentioned. I think Sumit is stuck. Sneha?
Abhishek, would you like to take the next question?
Yeah. So
Another question that people have been asking very much, whether purchasing a
Sumit, your I think there's an issue.
I will ask.
Abhishek,
Yeah.
please go ahead.
Yeah. So one of the questions which is repeatedly our audience is asking, whether purchasing a villa abroad and renting out is allowed for resident individuals after these new regulations.
If you can purchase and lease, is that what you're saying?
Yeah, buy and lease.
As a resident individual,
As
or
yeah, as a company, when whether you can do the buys and lease of the property, you can purchase the property and give to the lease
as bona fide business activity.
As a bona fide business activity by Indian entity.
Diana, would you like to?
So I think Dhruv had mentioned that the carve out has been done for construct and lease and not for buying and leasing. That's always been a gray area. Since they have, addressed construct and lease, this still will remain an open item. It seems that this would not be permitted by an Indian entity as, a bona fide business activity. They may look at it as a real estate business.
Yeah, thank you. So another question which most of the attendees is asking, what shall be the timelines of repatriation of funds, that is idle funds in account under LRS before 22nd August 2022?
Yeah, I'll take that. So basically, one key aspect which Diana has mentioned is that any asset or investment that you hold under the old rules and regulations will now be governed by the new rules and regulations with effect from 22nd August. So any idle funds that you have sitting outside. It seems, there's no clarification yet, but it seems that the clock for the 180-day period will commence with effect from 22nd August 22. So it is from that date and 180 days forward that you should reinvest. If you don't, you will repatriate the capital.
Thank you, Dhruv. Next.
Should we take one more last question?
Yeah.
Oh, so last one. Whether resident individuals are permitted to invest in VCC funds, /AIF funds, mutual funds.
Yeah.
And yeah, this is the.
Is that the, okay. So as I had mentioned, that units of VC funds can be subscribed to under the OPI regime. But very interesting fact is that, most of the VCs are also structured differently and may be structured in the form of an LLP or a company. And sometimes maybe shares are provided or LLP stake is provided. Now, in those matters, it may be a tricky situation because the instrument, they have non-debt instrument defines as units of mutual funds, and anything in an unlisted space which is a permanent capital would be categorized as an ODI or an OPI. So under unlisted, it would be categorized as an ODI investment. So yes, this leg would face challenges in terms of if it is not being issued in as a unit of the fund.
Okay, I think we'll call our session to an end. Thank you so much, everyone, for being such a wonderful audience. Thank you, Abhishek. Thank you, Sumit. Thank you, Dhruv and Diana, for this lovely session. If any of you guys have any questions or queries, you can reach out to us on the email IDs mentioned on the screen or otherwise. Look forward to help you resolve your queries. Thank you, everyone.
Thank you. Thank you all.
Thank you for being patient. Thank
you,
you.
everyone.
Yeah.